We begin tonight with the global stock market turmoil, which has been described as carnage and a bloodbath. As investors react to US President Donald Trump's trade tariffs, US and European exchanges have plunged following heavy falls on the Asian stock markets, with some of them recording their steepest one-day drop in years. Reacting to the continuing market turmoil, Mr. Trump told reporters on Air Force One that he's ready to talk to leaders from Europe and Asia. Correspondents say the world may not yet be in a trade war, but it is certainly in a trade confrontation between the United States and at least 60 countries, many of which are America's major trading partners. They say Mr. Trump believes that a US trade deficit is a big weakness, whereas most economists believe that with the US dollar in a position of global dominance, America can afford to have a trade deficit, and that this is not a weakness but a strength.
I don't want anything to go down, but sometimes you have to take medicine to fix something. I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal, but I said, we're not going to have deficits with your country. We're not going to do that, because to me a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even. We will be taking in over $1 trillion over the next short period of time with the tariffs that I've already instituted. They're already in place. Now, what's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. But I do want to solve the deficit problem that we have with China, with the European Union and other nations. And they're going to have to do that. And if they want to talk about that, I'm open to talking. But otherwise, why would I want to talk? They want to talk, but there's no talk unless they pay us a lot of money on a yearly basis. The report is that we had a deal pretty much for Tic-Tac. Not a deal, but pretty close. And then China changed the deal because of tariffs. If I gave a little cut in tariffs, they'd approve that deal in 15 minutes, which shows you the power of tariffs, right?
President Trump speaking to reporters on Air Force One. Well, and we've just heard actually that the president has threatened to increase the tariffs that he already imposed on China, saying he'll raise them to 50% unless the Chinese reduce the retaliatory tariffs that they have imposed on the United States. Well, Akin Oyedele is a deputy editor of investing at Business Insider based in New York. He's been following developments and he joins me now on the line from New York. Great to see you again. Thank you very much indeed for joining us. You have, of course, been covering the global stock markets for quite some time now. Do you agree with those who say that from Asia to Europe to the US, this is one of the biggest continuous sell-offs that the markets have suffered in a long time?
Absolutely, and thanks for having me on. That is true. The data does bear that out. The S&P 500 in the last two trading days, so Thursday and Friday, had its worst two-day sell-off, or one of the worst, two-day sell-offs since the start of this century, since the year 2000. In Hong Kong, the benchmark Hang Seng Index slumped about 13%, which was the most in a day since about 1997. So we are seeing the selling come swift and fast and setting all sorts of records that perhaps President Trump won't be happy to see, but it tells you the extent to which investors are nervous about the tariffs and the potential economic fallout.
Indeed. And I mean, as I said, you know a lot more about these things than we do. Just to explain the mechanism for those who might not be clear, it's investors deciding that the prospects for the big companies are badly damaged by what President Trump has done. In other words, they don't think these big companies are as valuable as where they were before the tariffs. And if there is a global recession, they'll be making lower profits. I mean, is that about the size of it?
Yes, that hits the nail on the head. So, stock prices essentially bake in expectations for companies' earnings growth, usually about a year out. discounted for where interest rates are. So a simple way of putting it is, if a stock price is up today, it's investors essentially saying that they believe the prospects for earnings about 12 months into the future are higher. And then a lower stock price generally reflects the opposite. Of course, things like emotions and irrational behavior get into the mix, but sort of by the textbook, stock prices generally reflect prospects of earnings, and earnings growth is the biggest driver of stock prices. So, where tariffs are concerned, what we've seen since what the Trump administration called Liberation Day last week is a lot of selling in stocks. And what that tells you is that investors believe that if and when these tariffs come in, they will force companies to raise prices. They will also lead to disruptions in company supply chains, long-standing sort of trade relationships that companies have had to source their materials for the things they make will be disrupted. They also are anticipating that company profits will be lower, and so that's what you're seeing reflected in stock prices. Now, where the economy comes into the picture is that if companies aren't selling as much as they anticipated, or if they're having to raise prices, then consumers, so you and I, we do not like to buy things when they're more expensive, and so we're going to likely to cut back on our spending, which sort of continues the spiral of higher prices leading to less spending, which means companies aren't as profitable as they need to be, and so that lower spending, at least in an economy like the US, which is very heavily reliant on consumer spending, once spending becomes in jeopardy or is affected negatively, then you start to talk about a recession. So that's the pass through from tariffs all the way through to recession, and that's why stocks are not taking any of this very well.
Well, that really is interesting, and thank you very much indeed for explaining it in very simple, very lucid terms. So, is it fair to say that it usually takes an enormous shock, like the COVID pandemic, for example, to trigger something like this? And analysts think that these tariffs might be just as big to push the world economy into a recession, and that's why we're seeing these continuing sell-offs. Just very briefly.
Yes, the answer is that it does take a big shock like this to see a global recession. If we think back, 2008, we had the global financial crisis, and the global economy sort of went unscathed all the way until COVID, which, I don't need to tell anyone who's watching this, that was a big shock to the system. So it does take major events like this to bring the world economy to its knees. And that, unfortunately, is the forecast among economists for the impact of Trump's tariffs.
And how are governments? I mean, I know you keep across. At the outset, you talked about the Asian markets. I mean, you keep an eye on European markets and so on. You keep across what's going on. How are governments of the biggest trading countries around the world reacting to this? Are some of them trying to do a deal with President Trump? I mean, because the White House is claiming that more than 50 global leaders are in touch with Washington to negotiate a deal, but we also know that quite a few of them are going the way of retaliatory tariffs.
That's right. So we're seeing both. We've seen China obviously come out with retaliation, and Trump today threatening sort of counter retaliation to the retaliation. We know that there are reports that Europe could soon roll out its own tariffs on the US. Canada is also likely to respond in kind. So we are seeing countries, speak out to sort of play the political game and say, we're not going to take this lying down. You can't just bully us into submitting to the terms and conditions of your tariffs. It's a trading relationship. We buy stuff from you too, in the same way that you buy stuff from us. And so if you slap tariffs on us, we slap tariffs on you. So we're seeing some of that play out publicly. But as you say, the Trump White House is saying that countries are reaching out privately behind closed doors to discuss. And so, we don't really have sort of 50 readouts of all 50 conversations that reportedly happened. But I think what we will see is the stuff that's rolled out before our eyes, and then some of the closed door conversations that many countries will initiate with the Trump White House to try and iron things out, or even delay some of the tariffs that Trump has announced.
And I think it's important that we should make it clear that the tariffs haven't actually come in yet, have they?
They have not. And so one of the interesting things that happened today actually was that there was a false report that claimed that Trump was considering a 90-day extension of the tariffs, and that briefly sent the US stock market rallying. And as soon as the White House responded that that was fake news, the market fell right back. So, um, the tariffs, it does take some time for them to work their way into the system. And we saw today the impact of any sort of delay in what Trump announced last week. But it does take some time for the tariffs to work their way. But like I said earlier, what we're seeing in the market is a forward-looking, anticipation of what the impact will be, and that doesn't look good.
And of course, as you mentioned, we still haven't seen a European response yet. If their response is a retaliation, how might that move things?
Well, on paper, that's not going to be received well. One could argue that maybe some of the weakness we've seen in markets has priced in some of the responses, but one theme that's emerged since last week when Trump, rolled this out from the Rose Garden is that this is a game of surprises. So the US's tariffs were bigger than everyone expected. China has had to respond in kind in a way that was more forceful than they perhaps would have initially. And so Europe's response could be also, unanticipated or unexpected in its size and scope, and that could lead to further market weakness. So, yeah, this has been a game of surprises, and Europe could respond in a way that perhaps markets and investors haven't yet priced in. And if that's the case, then that would um, extend the sell-off even further.
And of course, again, tapping into your expert knowledge of these things, I mean, there are usually winners and losers when you have stock market declines. But I understand that this time, virtually every one of the stocks is in decline, including banks, oil and gas companies, airlines, tech companies, retail stores, etc.
The damage is widespread. That is correct. I mean, there are a few individual companies that stand out as winners. I guess one to highlight would be Berkshire Hathaway, the conglomerate owned by Warren Buffett. And it's not because Warren Buffett's immune to stock market crashes as successful as he's been. One of the things that company has going for it is that it has an enormous cash pile of billions and billions of dollars that it has at its disposal. So that's part of what the market's looking at. That stock, for example, is up about 9% this year. And so it's vastly outperforming the S&P 500. So there are pockets like that of relative immunity, but like you say, it's a bloodbath across the board. Everything is being wiped out, partly because, we had a rally leading up to this that sort of lifted all boats, and that led some to argue that the market had been overvalued. And so now, with the prospect of a global recession, investors are saying, well, now it's time to take some of those profits, but also, in fact, dial down the amount of risk they're taking and maybe find parts of the market that are less risky, like things in fixed income, for example. So it is pretty widespread across the board selling.
And as we approach the end of this very, very illuminating conversation, I wonder what broad assessment is of how serious this sell-off has been, because some have called it serious, some have called it carnage, some even said it was a bloodbath. I mean, is this something of a crash? Are we in crash territory, or are we nowhere near that kind of level yet?
Well, it's sort of a pick your synonym, pick your synonym exercise. I would say I think it's fair to call it a crash because of how quickly it's happened. Um, the S&P 500 could close today down 20% from its recent all-time high, which meets the definition of a bear market. Um, and so I think it's on that basis, it is fair to call it a crash. Of course, a lot of people on Wall Street tend to pick their words carefully and not be alarmist, but based on the speed with which this has happened, I think based on the fact that in Asia, some of the exchanges hit levels that trigger what are called circuit breakers, which is when the exchanges basically close because it's like, okay, this is too chaotic. Everyone, pack your toys, sit in a corner, think about your life, and then come back to trade. Based on the fact that we've hit some of those levels or come close, I think it's fair to call this a crash. And what's concerning is that we may not have seen the worst of it.
Well, that was actually going to be my final question to you. I was going to say, I mean, you work for a very well-respected business publication. I mean, as a sort of, deputy editor of investing, as you look forward, I mean, do you see any signs of stability returning anytime soon, or is there too much uncertainty and volatility right now?
Well, never say never. But if we think about what could bring stability, it's at least two things come to mind, and we wrote about this today. One is if the Federal Reserve steps in by lowering interest rates or any other measure to ease monetary policy. But the thing with that is that that would at least theoretically be inflationary, and so they aren't likely to go down that road. The other thing that could stabilize all of this is, just keeping in mind that this is policy, and so it's deliberate. And so the Trump administration can come out and say, we are extending, or sort of pushing the timeline down the road, or we're lowering tariffs, or we've spoken to 50 countries and 30 we're happy with, and so we're cutting tariffs. Anything they do to sort of lessen the blow to some of these countries would bring stability. But to both of those points, like I said, there are very valid and potent counterpoints. It's unlikely that the Trump admin, at least based on what we've seen, they're not backing down. And the Federal Reserve kind of has its hands tied because it has, just been fighting inflation for the last couple of years and understands that lowering interest rates at a time like this would bring that beast back. So, I don't have a crystal ball, but it's hard to see what could stabilize this, except something that surprises us.
Listen, mate, I want to thank you very much indeed for your time and your analysis. Akin Oyedele is a deputy editor of investing at Business Insider based in New York, and he has been following developments from New York, and he was talking to me from the so-called Big Apple. Thank you very much indeed.